there is some bit of momentum in small cap space.
Small cap index, fell 55% in those 2 years and 3 months, and mid cap index fell 45%. And during that phase, even though many small cap, mid cap stocks were reporting good earnings in India, still the stock prices kept on falling. However good an investor you may be, if you're investing in small cap, mid caps, you need, along with the industry cycle, you also need the market cycle, that is liquidity.
Are there any other macros that you generally see for investing in India, or you are more of a bottom-up guy?
The most important macro variable to track at all points of time for all equity investors in the world is interest rates. Warren Buffett has taught us that interest rates act as a force of gravity.
As a retail investor, how I can go and approach and figure out these sectors that might tend to do well? What are those sectors where you're seeing this good scarcity premium in the next 3 to 5 years, especially in India?
However good a company it may be, or however good the management quality may be, it is not in an industry enjoying a sectoral tailwind. You will not.
वीडियो में आगे बढ़ने से पहले हमारा लॉन्ग अवेटेड प्लेटफॉर्म गेट प्रॉस्पर ऑलरेडी लाइव है एंड आपके फेवरेट सेबी आर एक्सपर्ट्स ऑलरेडी ऑनबोर्डेड हैं, जिनके प्रूवन पास्ट रिकॉर्ड्स के साथ आप उनके स्टॉक रिकमेंडेशन एंड पोर्टफोलियो रिकमेंडेशन की हेल्प से खुद की इन्वेस्टिंग जर्नी को और आसान कर सकते हैं, जिसका लिंक आपको डिस्क्रिप्शन में मिल जाएगा। सो उसे चेकआउट करना बिल्कुल मत भूलिए। एंड अगर आपने अभी तक हमारे इन्वेस्टिंग व्हाट्सएप कम्युनिटी को नहीं ज्वाइन किया है, सो प्लीज़ डू ज्वाइन दैट, क्योंकि हम वहाँ पर रेगुलर अपडेट्स इनसाइट शेयर करते हैं जो आपको बिल्कुल मिस नहीं करने हैं। सो उसका भी लिंक आपको डिस्क्रिप्शन में मिल जाएगा। एंड यस, चलिए अब वीडियो में आगे बढ़ते हैं।
So, Gautam, thank you so much for doing this with us. We are very, very glad that you joined us for this call. Different time zones, different time for both of us to be, and we have been recording this. So, to begin with, Gautam, first thing first, we are in 2026, where Indian markets have been almost at the same, index level from the past 2 years. Whereas, small cap has started doing, there is some bit of momentum in small cap space. So, what is your thought process regarding India?
Well, I'll answer, the first part of your question. That is, why the Indian markets have been flat for the last 2 years. So, a large part of the index, in India is comprised of banking and IT services.
Correct.
And IT services has got badly disrupted because of AI. So, the IT index alone, as we speak today, is down 43% from the all-time high. TCS and Infosys are down more than 50%. Who would have thought such a day would come? So the headline indices may continue to struggle because the banking sector also may face some pressure from, in terms of asset quality because of the fallout from the Middle East wars and the tariffs of last year. So when 40% of the index is facing headwinds, it's very natural for the index to not give meaningful returns or remain stagnant or range bound. But the real growth story, like you mentioned, the small caps, the small caps and mid caps, that is where the real action is in India. It's in the broader market. The real growth story of India lies in the broader market, and I firmly believe that we are in stage one of a new bull market in India. And you're already seeing
Okay.
since 2nd April how mid caps and small caps are performing as a group. It's becoming more selective. This rally has lasted almost 3 months now, and now from here on, I think it will become more selective, and it will be a bottom up stock pickers market.
All right. But do you think there is some value buying in IT sector or private banks in India as of now, or still, or there is a structural change that has happened in the industry?
Well, I would not try to catch a falling knife as far as IT services is concerned. Within banking industry also, the NBFC space or the non-bank lending space is an area where we can selectively look at. For example, microfinance sector seems to be turning around. Gold finance, gold, because gold prices have corrected. So, you have had a decent correction in the gold finance names as well. That's an area to look at. But I think as far as the general frontline banks are concerned, they're increasingly becoming commoditized. It's very becoming very difficult to differentiate between the leading banks because almost all of them offer the same suite of services. So it's increasingly becoming commoditized. So I don't think they should command the same 4 to 5 price to book multiples as in the past. I think the derating, has continued for the last 2 years. It'll, probably continue for a little more while as far as banking names are concerned.
Correct. And like in times like this, when our currency, depreciates at a much faster pace, we saw the currency falling from 85 to 95, in just a couple of 5 to 6 months time span. So at that point in time, the IT tends to do well because, they are exporting services. So despite that happening, the IT services still was not able to do any good. So do you think there will be more correction in the IT sector, or, it will get stagnated at this point in time?
Markets tend to reward organic revenue growth. They do not reward a temporary boost in your top line headline numbers on your revenue because of a currency dip. If the IT services companies were announcing big deal wins, and adding new clients, big contracts, then the market would have rewarded them. But there's actually
Right,
pricing deflation which is taking place in IT service contracts because
right,
of AI. So that is why you're seeing such a sharp derating. Many of these leading names may fast approach single digit P multiples. I mentioned this a few months ago on Twitter as well, that I expect all these large frontline IT services companies to eventually trade at single digit P multiples because the terminal value of these businesses has gotten disrupted because of the uncertainty driven by AI. So I think these will remain value traps, and a lot of people will invest, try to catch the falling knife because of high dividend yields and high free cash flow yields. But in India, markets do not like companies and stocks with flat revenue growth or low single digit revenue growth. Markets
correct.
in India tend to reward organic revenue growth disproportionately. So if you can find companies in the IT services or outside, which can deliver you that organic revenue growth with potential for margin expansion, I think that is where you'll find the real big winners of this new bull market in India.
Makes sense. And for the simplicity and for the viewers, can you explain what a terminal value is and how does it impact the IT valuation all at once?
Terminal value simply refers to longevity of the growth of any company. So
Correct.
basically, like in traditional discounted cash flow models, we tend to forecast cash flows for the next 5 years or maximum 10 years, and then we assign a multiple to the, we assume that the growth will continue in perpetuity after that initial discounting period at a certain rate of, for example, we assume a long term growth rate in GDP of the country, and then we apply that same growth rate in perpetuity to the cash flows of the company. But if there is uncertainty regarding the trajectory of the future cash flows of a business in the long run, then the P multiple derates a lot, because if you conduct any simple DCF analysis for any company, you'll notice that the terminal value beyond the first 5 to 10 years is where the bulk of the
Hmm.
intrinsic value of a business resides. So if that is
Correct.
getting threatened because of a technological disruption, the markets will not wait to see what will happen 5-10 years down the line. They'll immediately derate the stock of the company in question today itself.
Correct. So is this the same reason why an Anthropic or a SpaceX is valued so highly because the future value, the terminal value is tending to be very high as of now?
Yes, when in case of those companies, especially, the future terminal value is actually unknowable. It's a very potentially large TAM, total addressable market, which these companies are trading at. So in one situation, in case of Indian IT services companies, the total addressable market is actually shrinking because of AI. On the other set of companies like Anthropic, you're actually seeing the total addressable market expand because of AI. So that's why you are in one case you're seeing P expansion, in the other case you're seeing
Hmm.
PD rating.
P. Correct. And to what extent can the P expand in those sectors, and to what extent P can, uh, you know, come down in this sector? For this sector, you mentioned that it can go to single digit, but in that sector, what is the extent till which it can go? And, after that point in time, we can say that it's now overvalued.
So basically, in my experience, the P ratio for any high growth business in its infancy or initial stage of growth tends to keep expanding all throughout the high growth phase of the company. It never tends to come down until the high growth phase is there. So in the past, also in India, we have seen many companies. In fact, let's take a simple case study. For example, DMart. It started with a 50p multiple, then got re-rated to further to 100p multiple, then to 200p multiple, and then once the growth rate started slowing down, then the stock got derated after that. So valuations for high growth companies basically start from reasonable valuations, then they go to expensive valuations, then very expensive, and then finally they reach absolute valuations. And then once the growth trajectory tops out, that is when you see a big fall in the stock price, and the
Got it.
derating of the P multiple. So instead of giving a fixed number that this much P is expensive, I would simply focus more on the growth of the company and the quality of the
Correct.
earnings of the company, whether the company is able to grow at a good speed without straining its balance sheet. Because companies, there are many set of companies in the market. If they want to grow fast in terms of top line, they have to resort to equity dilution or raising debt, because their working capital situation is very stretched. So the markets do not give those kind of companies that astronomically high pay multiple as they would give to a free cash flow generating
Got it.
company.
And say, for example, so we talked about currency also as one of the macro factors. So, uh, are there any other macros that you generally see for investing in India, or you are more of a bottom-up guy?
The most important macro variable to track at all points of time for all equity investors in the world is interest rates. Warren Buffett has taught us that interest rates act as a force of gravity on valuation. So,
Okay.
if
Okay.
the interest rates, in history has taught us that all bull markets, especially in the Nasdaq in the US, tend to end with a sharp spike in interest rates. If the rate of increase in the interest rates is slow and gradual, then you can have a situation of rising interest rates along with rising equity prices, like for example between 2003 and 2007. But if the pace of increase, or the speed of increase in interest rates by the Federal Reserve in US is very sharp, for example 2022, in that case you saw what happened to the Nasdaq. The Nasdaq fell 40% in 2022 alone,
Correct.
because the pace of increase in the interest rates was very, very high. So if it's slow and gradual, the markets adjust and move on. If it's very sharp and dramatic in terms of the increase in its pace, then you will see a sharp correction in the Nasdaq.
All right. And in terms of valuation multiples, so you mentioned uh, rather than just looking at the P, we should also look at the growth. Or P should not be looked at on a standalone basis. It should be coupled with growth because in a rising industry, the P will expand along with the growth. So, is there any metric, any ratio that you see particularly to track the valuations and combine it with growth and see how the company is performing on both the fronts?
That's a very good question. So I'll mention two white papers here that will clarify everything for our viewers. So first white paper is called "What does the price to earning? What does the P multiple mean?" by Michael Mauboussin. That's the first white paper. The second white
Okay.
paper is titled "The P Ratio: A User's Manual" by Epoch Investment Partners. If you can
Okay.
just read these two white papers, you can determine the justified or fair P multiple for any listed stock in the entire world. Any stock market of the world,
Okay.
you just read these two white papers, you'll understand how the interplay of earnings growth along with return on invested capital determine the fair P multiple for any listed company. So this is, and so if you are able to buy a stock at below the justified P multiple or below the fair P multiple, then over time you'll benefit from earnings growth, earnings per share growth, and you'll also benefit from potential valuation re-rating. Conversely, if you
Okay.
buy a stock well above the fair or justified P multiple, then over time, even though you'll make gains from the earnings per share growth, but there is a potential for a P de-rating as the stock eventually, de-rates back to
Got it.
P multiple over time. So, any serious investor should definitely read these two white papers.
So, Gautam, since you look at both of these things, like the growth and the price to earning ratio, how would you classify yourself? Would you classify yourself a growth investor or a value investor? How would you, which bucket would you put yourself
So
in?
I invest only in India. So for in an India in the last 18 years of investing, I've realized that Indian markets reward growth and growth only. And in bull markets, any quality of growth is rewarded. But in bear markets, the Indian markets differentiate. So in bull markets or bullish environments, P&L, income statement, and top line growth matters to the Indian market. But in a bear
Correct.
market, like we saw from September 2024 till
Mm,
2nd April 2026, it is balance sheet and cash flow which matters. It's not just the growth alone in isolation. So
correct.
once you experience a few bear market cycles in India, and once you graduate to the level of a fund manager, then you realize that okay, you're willing to forego or forsake a bit of returns in bull markets because you want to contain the drawdown or the loss of capital in bear market. So you want to invest in high quality growth companies all throughout across market cycles. That's basically how you
Correct.
establish a sustainable and durable track record of good investing in India.
But there are some phases where, even good balance sheets and good cash flows are not getting rewarded. So how do you remain patient or how do you, stay confident that this might work again?
You mentioned good balance sheet and good cash flow is not getting rewarded. For example, if there's a very bad bear market or severe bear market in small cap mid caps, for example, from January 2018 till February of 2020. Okay, there was a 2 years and 2 month long bear market in small cap mid caps
Correct.
in India. Small cap index fell 55% in those 2 years and 3 months, and mid cap index fell 45%. And during that phase, even though many small cap mid cap stocks were reporting good earnings in India, still the stock prices kept on falling because it
Correct.
was just the market cycle was against you basically. And I have realized this over time.
Correct.
However good an investor you may be, if you're investing in small cap mid caps, you need, apart along with the industry cycle, you also need the market cycle, that is liquidity on your side. So like in the last 3 months since 2nd April, so you have seen liquidity coming back into small caps and mid caps
Small
selectively.
and
So you're
mid cap.
seeing from the bottom, a small cap mid cap index is already up 15% in the last 3 months after the end of the most recent bear market. But during that bear market from September 2024 till 2nd April 2026, the small cap index fell 20%. So it was just a handful of stocks which delivered some gains to you, while the majority of the listed space basically fell by the
Did-
wayside. So a lot depends
Correct.
on the environment, but you should not
Right.
lose focus of the cash flow and the balance sheet and the quality of the promoter. In India, promoter risk is the biggest risk when you're investing in small cap mid cap stocks. So do not compromise on promoter quality, that is corporate governance. You have to be very very careful on that front.
So you mentioned two things. One was about liquidity, one was about promoter risk. So I'll ask one by one. So when we talk about liquidity in India, I think in the past couple of years, the majority of the liquidity has been provided by the DIIs or indirectly the retail investors of our country through mutual fund investments, through SIP flows, and so on and so forth. Do you think we'll get an add-on liquidity from the FIIs anytime soon in India?
We'll get a big inflow from FIs only when the AI trade reverses, because see, at the end of the day, FIs also have a limited pool of capital to invest. If they're seeing
Correct.
super normal abnormal growth in countries like South Korea through SK Hynix and Samsung, in Taiwan
Right.
through TSMC, then why will they bother
Hmm.
investing in a country like India, where then they also face the headwind of currency depreciation? The
Correct.
FI exodus, or the complete apathy from foreign investors in Indian markets will continue until the AI bull market is on, because this FPIs and FIs have got so many avenues at reasonable valuations to invest overseas. In India, it's only in the Q4 of FY26 that we finally saw a resumption of earnings growth in small cap mid caps. Prior
Correct.
the 8 quarters prior to that, they were experiencing a sharp slowdown in earnings. At the end of the day, it's all about earnings growth. Now
Correct.
what you observe going forward this year, especially, is that FIs will come back selectively in a few pockets in small cap mid caps where they find promise of good top line and earnings growth. That is where you'll see FIs coming back. But I don't see them returning back in a broad based way to India. It will be very very selective and bottom up.
Correct. And with regards to retail investors doing it through DIIs, do you think they will stick by for the next 1 year, 2 years, despite not having returns from the Indian
Well, the
markets?
SIP
Or they'll
stoppage,
chase?
yeah, that's a good question. So the SIP stoppage ratio is increasing. So a lot of people are starting to lose patience. That's another very good bottom indicator in my view, because when you see a lot of inflows coming into thematic funds or sectoral funds like we saw in August and September 2024, that was indicative of a blow off top or a euphoric top in small cap mid caps. But now that you're seeing SIP stoppage is increasing, and certain section of retail investors losing interest and giving up on equities as an asset class because of lack of returns. That's also a contrarian bottom indicator in my view. So basically, the same cycle keeps repeating. In every bull and bear market cycle, retail investors tend to exit. Near the after just at the end of a bear market or immediately after a bear market has ended, and then as once the new bull market has run its course for a while, and then they again get attracted by the recency bias of high returns, and then they again come back towards the very end fag end of a bull market, and the cycle keeps repeating year after
So
year.
as somebody who manages fund, do you also see that the fund making good returns over a period of, say, for example, 5, 10 years, but the investors participating in the fund do not make returns because of their entry and the exit that they choose?
So I'll give you an example from my fund. So I run a hedge fund in US, Stellar
Correct.
Partners India Fund, and we started operations on 3rd of October 2022. And
Correct.
in the first 3 years, 9 months, we have only had two redemptions. And guess when did those two redemptions happen? Just and the last few months near the end of the previous bear market at near the very bottom.
Oh,
So,
okay.
like it was very
Right.
unfortunate. I tried to reason with them that a new bull market started, but the pain of the currency for my US based investors, for those two US based investors, was too much to
Mm-hmm.
bear, because the
Correct.
Indian currency fell 15% from September 2024 till
Correct.
March 2026. So this, for the foreign investors, individual and institutional, the Indian currency matters a lot. Like in real life, in
Correct.
practical life, it matters quite a bit. So so they are just concerned with USD dollar returns at the end of the day. So if your currency
Exactly.
falls so
Exactly.
sharply, I'll give you one more data point. So the Indian currency crashed more than 25% versus the euro currency in the last over the last 12 to 14
Because
months.
because the euro appreciated against the dollar. So
Plus, exactly. So first you depreciate versus the dollar, plus the euro appreciated versus the dollar, so you got a double whammy. So imagine the plight of a Europe based investor. He'll never look at India again. Once he's gotten out of Indian market, he'll not even consider India for the rest of his lifetime, possibly, because he will simply think, how can I bear a 25% hit on the currency in local euro currency terms? So, that
correct.
currency. That is why you saw finally the government of India woke up, and the Reserve Bank of India announced big bang reform measures to prop up the currency and stem the outflow of foreign investors.
Correct.
This recent practice of making capital gains and interest tax free on government bonds was a game changer, because you notice the
Mm.
currency ever since that announcement has strengthened, and the bottom is now firmly in place for the Indian rupee from here, and at least till the time this particular scheme is in force.
Has there been a case before this as well where our currency double depreciated against the euro because the euro appreciated against the dollar?
Yes,
Hey,
2013. Yes, it has happened in the
okay.
past. That time also the same
So
Raghuram Rajan took office in September 2013, and he also introduced the same exactly same measures in FCNR deposits to attract NRD.
okay.
The same playbook has repeated
Okay.
13 years down the line.
So, and do you also see government, taking a stand to make things easy for FIIs in terms of taxation, in terms of LTCG and all those things?
I doubt it, honestly. The past track record does not inspire confidence in me. And they anyways got what the main thing which they wanted was to stem the, you know, fall in the currency, that they managed to do very, very well in a non-disruptive manner through measures in the government
So,
bond market.
capital market flow is not something that they're concerned about.
I think this government, just does not take a very favorable view of stock market profits per se. In my view, this government is firmly socialist. 80 crore people in India today, are getting free food ration every month. So this
Okay.
government is very clearly focused on slow and steady reforms. Their focus is more on improving ease of doing business in bits and pieces every year, other than big bang reforms on the stock market side. Because see, the previous like many years ago, the Congress government basically they introduced STT, and in lieu of introducing STT, they removed long term capital gains tax completely. What did the Modi
Correct.
government do after coming to power? Not only did they keep STT, they also introduced long term capital gains
LTCG,
tax at 10% first in 2018 budget. Then they further increased it to 12.5% long term capital
12.5%.
gains
Correct.
tax. Previously,
Correct.
the short-term capital gains tax rate was 10%. What did Modi government do? They increased it to 15% first, and the
15%.
20% later.
20%
So
late.
the best predictor of future actions is the past track record. Look at the past track record of what this government has done as far as the capital gains tax rates is concerned. They need funds. The government of India, in a capital efficient country like India, and this, for the current government, the stock market is like low hanging fruit. So they just want to milk the stock market people as much as they can, unfortunately.
So it is very contrasting because the same person who was in power in Gujarat and I come from Gujarat. The mindset was really towards capitalism and businesses were promoted and businesses were doing well and are still doing well in Gujarat. There are two things to it. One is because of the people, and the second is obviously because of how the government supported it. But the stance, as you mentioned, changed drastically once it came to the power at the central level. So that's a very unique thing I think I got to know from your side when we were discussing this. One more very interesting thing that you mentioned, that small caps have started doing well. Now, when you say that small caps have started doing well, but I also tend to see that Small caps have already started trading at a P multiple of around 30, 35 at the broader index level. So some of the individual stocks I'm very sure are much more expensive than that. And this level is generally their median level in terms of, what P multiple they tend to have had in the history. Do you think there is more fuel to this and it is just stage one, or it is just, some retracement that has happened and it will, slow down again?
See, whenever people talk to me about P multiple at an index level, be it Nifty or mid cap index P or small cap index P, my simple retort to them always is, you're not index investors, you're not investing in the index, right? So if the index is an average, right? So basically it's an average of high P stocks, low P stocks, and within the high P stocks, low P stocks also. So in the Georgia compounding, I mentioned this, that a high P stock is not necessarily expensive and a low P stock is not necessarily cheap. Look at what has happened to
Mm,
IT, for example. These stocks went from 30p multiple, 25p multiple, then to 20p multiple. Now they're at 15p multiple. Who knows, they may deal it further to single digit p multiple. So it's all about understanding the future trajectory of growth in the company instead of generalizing them that 30p is expensive or 50p is expensive. I'll tell you how the Indian markets work in practice, because this is very important for newcomers to understand. So if there is broad-based growth in the small cap, mid cap space, and again the economy, then then the money gets distributed among many names, and stocks tend to trade near fair P multiples. But if only a handful of companies are displaying very good earnings growth and revenue growth for in excess of suppose 30-35%, while the majority of the market struggles at low single digits, then what you'll notice happening is that the market starts operating on the principle of scarcity premium. So these 30
correct,
25% growth names do not trade at 30-35p multiples. They'll start trading at 70-80 or even 100p multiples. Why? Because the Indian markets work on the principle of demand and supply. The supply of
correct,
high growth, high quality equities is very limited, whereas the demand for them is always very, very high. So,
right,
so that's why the markets differentiate, even in terms of the valuation, which it accords to different kinds of businesses. You'll notice that businesses which are growing at earnings at 10-15% for the next 2-3 years, they are given P multiple of 10 to 15. But
mm,
companies which are promising growth rates of 30-35% or more over the next 2-3 years, they end up getting more than double that
correct.
figure in terms of the P multiple. So it's a very unique market. It's a very unique nuance specific to the Indian markets, and this is why real experience in the Indian market is required. This textbook definition of investing based on valuations will not work in the Indian market. This market
Correct.
works on the principle of scarcity premium and demand and supply.
So, what are those sectors where you're seeing this good scarcity premium, or the sectors that might tend to do well in the next 3 to 5 years, especially in India?
That's again a very good question. So I'll share a very big learning from my investing journey of the last 18 years, Kunal, that I've realized over time that however good a company it may be, or however good the management quality may be, if it is not in an industry enjoying a sectoral tailwind, you will not make money. If you buy the best
Correct.
businesses and which are in the middle of an industry headwind with the best quality management, you still will not make money. You need to basically make yourself, your thought process, and your portfolio forward looking. So how do you basically structure a portfolio? You want to basically have a portfolio of businesses from a handful of industries which are poised to enjoy tailwinds and very good growth prospects over the next 2 to 3 years at least. For instance, data center ancillaries. The data center build out has been occurring in the US for the last 3 years. In India, we are just getting started now. So so data center ancillaries are a very good place to look for pockets of growth over the next 2 to 3 years. Simple example. What do I mean by data center ancillaries? So there are listed companies in India, for example, which makes skids for cooling solutions, and in data centers, there are companies which make optic fiber cables for use in data centers. Those are examples of data center ancillaries. Power sector ancillaries are also another very big theme, because the biggest bottleneck in the AI world today, in addition to memory, is power. So basically, and especially those operating in the high voltage segment or HDV, HVDC segment, those are the places to look for. So, for example, here again you'll have companies in the transformer segment, or other parts of the power value chain where you want to focus on. So this is one more theme which should do very very well over the next few years. In addition to this, no, because of all the FTAs, free trade agreements signed between India and various countries of the world over the last 1 year, and the Indian currency depreciation versus the US dollar as well as the Chinese yuan, you're seeing a boom in export sector in India, especially in within that, especially those companies which are in the area of precision engineering. So, in simple terms, it means highly specialized manufacturing exports. Those are the, and how will you understand whether a company is, precision engineering company or a plain vanilla manufacturing company? It will show up in the margins and the terms of trade of that company with its customers and suppliers. So, just check the working the receivable days and the payable days for those companies. This data is publicly available on screening tools like screener.in and other screening tools. You basically want to look for companies which have a barrier to entry. They have to have very highly specialized manufacturing expertise. That's one more area where you will see a lot of good growth over the next few years. So in addition to these three areas, power sector, data center, and precision engineering, I would also like to highlight one more area, which is aerospace. So aerospace is a sunrise industry in India. Airbus and Boeing, after more than a decade, have finally started seriously outsourcing work to India. Yes, and there's a reason for that, why it took so long. This is an industry with very, very high entry barriers. So the qualification and validation cycles in the aerospace industry, because it's you're dealing with life of humans in in aircrafts, the qualification validation cycle is very, very long. A single
Right.
aircraft is made up of more than 4 lakh parts, Kunal. So it's very complex piece of machinery. But but once you pass the validation stage, qualification stage, and become part of the ecosystem of Airbus and Boeing as a tier one or tier two supplier, then you get visibility of growth for many many years out, more than a decade out. That's why you'll see the handful of aerospace listed companies in India. They are getting P multiples already 80, 90, 100 P multiples right now. Why? Because the market is right now placing them immediately on that high P multiple, because these companies have got longevity and durability of growth for the next decade. Once the market gets hand of visibility of growth for a long period of time, it just loves such businesses, and it gives them a very very high P multiple. So aerospace, precision engineering exports, data center ancillaries, and power sector ancillaries. In addition to this, the auto ancillary companies in India, which are pivoting to more higher margin areas of aerospace, defense, and semiconductors, those select auto ancillary companies should also do very very well, because that's all they are also part of. They are basically trying to venture into the precision engineering field essentially, because if you
Field
are,
lesson.
because if you are an auto ancillary company, it's very easy for you to pivot into allied areas like aerospace. If you can do auto ancillary, you can do aerospace as well. So basically, if-
Correct.
look out for companies which are making this pivot into higher margin areas. And finally, one more sector we are very bullish on for the next few years of this new bull market is innovator CDMO companies, contract manufacturers, which are working with large innovator pharma companies in the world. Why is that? What artificial intelligence AI has done is it has greatly compressed the timeline for clinical trials for discovery of new molecules. So discovery of new
Okay.
molecules going forward won't be a problem. What these large pharma companies of the world will require is, players, especially because of the lack of trust with Chinese vendors. What they're looking to do is, diversify into more high trust places like India, where they have more comfort, and they're looking for players, CDMO players, which have got very large established scale of operations and FDA compliant facilities in place. So this is again
Correct.
a very exciting area
Mm.
for growth for investors in the Indian market.
So, Gautam, while you were mentioning the industry, I saw a couple of stocks. So, the idea is not to discuss those stocks, but the idea is how the price is behaving. So, for example, regarding the aerospace industry, when you spoke about, there was a company that came to my mind that was Rossell, Texas, that provides equipment. So, that has been doing really well. It's been making new highs as days go by. On the other hand, there is Tejas Networks, which is into optic fibers, but that corrected recently and then now has started doing well again, but still it's 50% away from its all-time high. So how, two high growing industries have two, very different kind of stocks with very different kind of stories in the stock prices.
So, so you mentioned a few names here. We do as Telewealth Partners India Fund and as well as Complete Circle's Telewealth PMS. We do not hold any of these stocks which you mentioned. But I'll give you an idea. I'll give you an example of how I've gone about participating in this trend. So in my fund in the US, just a few months ago, I bought a stock called Sterling Technologies. We have booked out of that now, but that stock went up more than 200% in just a 2 3 months time. It was basically in the area of making optic fiber cables for data centers, and it has also got a very big telecom exposure. But the unique thing about Stellar Technologies compared to its peer HFCL is that Stellar Technologies is backward integrated in preform. So basically,
Okay,
layers, if you're backward integrated into preform, then you enjoy higher margins. It is similar to how integrated steel companies like Tata Steel enjoy higher margins because they are integrated backward integrated into iron ore.
correct,
Iron ore prices rise. These backward integrated steel companies make a larger margins and disproportionately higher profits. Similarly, Sterling Technologies markets basically just rapidly discounted the potential exponential surge in earnings, and the stock just got re-rated from a 100p multiple to a 300p multiple on a trailing basis. So the way to participate in this trend is to basically have a trailing stop loss or some quantitative stop loss in place, and then you ride the trend, because the valuation, like I mentioned, this has become absurd in the short run. The earnings may still come
correct,
through, but the market has already discounted many years of earnings growth ahead in this particular
right,
company. So this is and similar to the company you mentioned, Rossell Tech. You'll notice the P multiple for in that company is very very high, but the company is promising very
correct,
high growth rate in earnings for the next few years. That is the reason why the market is giving that stock such a high P multiple. Same thing with companies like Aquas and Unimec Aerospace and Azad Engineering. We do not have any exposure in these names in the PMS or the India Fund, but the reason why I'm mentioning these names to you is to make you understand that the time to buy these stocks was a few months ago, during the end of the bear market when they were available at reasonable valuations or expensive valuations. Now many of them have reached absurdly high valuations, and therefore it will become difficult to justify entering at these valuations. Not a stock recommendation, but I'm just trying to explain the thought process so that you
yes,
want to
got
get into these high growth companies. Basically in India, again, we go back to that scarcity premium and demand supply point.
it.
You
Point,
can only hope to get into these companies at fair or expensive valuations during a bear market. Because in normal market they will trade at absolutely high P multiple.
double high,
It will
no,
become very
correct.
difficult for you to enter those names.
So for retailers, doing a direct investment or getting a direct exposure at the right time, I think is almost very close to being, it being impossible.
It's very difficult. Yeah,
We
for
need,
example, for
yeah,
sure. And that's why for many retail investors who are not experienced practitioners, I always tell them go for the SIP route. Why? Because in expensive markets, your SIP will buy you lesser number of units, and in better markets or bad markets, they'll buy you more number of units. So it's basically the best. You're exhibiting the best form of investor behavior, buying more during dips and buying less during periods of euphoria.
correct. And in the entire discussion when we were talking about sectors and companies, you mentioned ancillaries in almost all the sectors that you spoke about. Why not the company that is running things at the forefront, and why more talk about ancillary businesses?
One company's cost is another company's revenue. Look at what is happening in the
Correct.
US, for example. Why do we talk about keep talking about the AI infrastructure or AI ancillary companies? Because the
Mm,
hyperscalers, Oracle, Meta, Amazon, Google, they're spending hundreds of billions of dollars on capex. Their cost is someone else's revenue. So the
correct.
memory players or the transformer companies, or or companies providing cooling solutions or chips, they are, for them, these hyperscalers cost is their or expense is the revenue. That is the reason why I was
Correct.
mentioning ancillaries repeatedly, because you want to basically focus on that. Basically, for each, before making any investment, you simply do a mapping of the value chain of that particular industry. Within the value chain, you'll notice that in certain areas within the value chain, wherever the competition is least. For example, you'll notice that certain parts of the value chain, there is only one or two suppliers or companies which are enjoying bulk of the market share, or they are dominant in
Correct.
market share, or what we call supply side dominance. Those are the companies you basically want to back with your capital, because competition acts as friction for value creation. You want to,
Correct.
minimize. Warren Buffett, again, I'll quote him again here. He says the secret to life is weak competition. So you want to basically look
Right.
for areas, where there is as less competition as possible.
Competition
That's why
as
I
possible.
mentioned about this, ancillaries again and again, because there you basically you can find, with some work you can find companies operating in monopoly or duopoly
Or
or
duopoly.
oligopoly industries.
Got it. And say, for example, Gautam, you selected a sector and you are very sure that the sector has tailwinds. And now, say, for example, there are four players doing well. So, not a very high competition, but not very low as well. So, do you go with all four, or do you handpick one of them or two of them, which has the greater market share, or which is, say, for example, has the greater order book? How do you go about that?
Very good question. Again, very simple answer. Go for the company exhibiting the highest revenue growth. Why? If it's a oligopoly industry, and if you're growing at above the industry growth rate, automatically it means that you're capturing market share from your competitors. And this market share capture is a source of great value creation for your equity shareholders over
Right.
time. So that's the most. So don't go by the past market share. That means nothing. For instance, I'll give you a live example here, not a stock recommendation. There was a time when Maruti Suzuki used to be the dominant player in terms of market share in the Indian passenger vehicle market. But then
Correct.
but then you saw the resurgence of Mahindra and Mahindra, how they're capturing markets
Correct.
rapidly away because of the
EV
surge in
part.
SUV demand in India. So so one player, the legacy player, which was dominant, which had dominant market share, ended up losing market share over time. So that you saw the effect on Maruti stock price. On the other hand, the market share capture by Mahindra and Mahindra led to great value creation for its equity shareholders over time.
Correct.
This is what you want to focus on, not the past market share. Past in investing means nothing. Investing is a
Correct.
probabilistic bet on what may likely take place in the future. It's all about the
Correct.
future. So basically look for the trajectory of market share gains in individual players.
So, and with regards to ancillary, I always wonder that what if the main player to which the ancillary company is providing solutions or some parts to it or some products to it, what if tomorrow that main business starts focusing on the ancillary part of it as well, just to ensure that there's vertical integration in the entire business?
That's a very good question. And why? But why don't the main OEM or original equipment manufacturers, why don't they actually do this? Because there's a trend of these OEMs or the main manufacturer. They want to focus more on branding and marketing, and they want to
Okay.
keep their operations asset light, while they outsource all the grunt work, all the heavy duty work to companies who are willing to operate at lower margins with higher working capital requirements while making decent return on capital employed. So that's basically how this entire model basically is operating across the world. But that risk will always remain in case the OEM ever decides to backward integrate. Then the market will again start focusing on terminal value risk and derate these ancillary companies very sharply.
Ancillary company. So that is one of the risks I think majority of the ancillary companies run, but it tends to happen on the lesser side. ऐसा बहुत बार देखते हैं कि नहीं होता है ऐसा. Is
In
what
investing,
I have seen in that.
in
Yes,
investing, we all have to live with the risks that we can understand. This is the mantra for investing, because
correct,
if you start focusing on the risks in every business, you'll be unable to invest in a single stock. There's no stock in the
correct.
world, at least in my experience,
With
which
a
does not have some potential risk to it. That is why you're getting it at the value that you're getting it at, right? So there's
correct,
you have to be you have to, and when you're underwriting the risks involved in the business, you have to be adequately compensated for those risks. So your required rate of return basically then starts going up, and then therefore the fair pay multiple for that business in your eye goes down. So it's a very nuanced topic. There's no fixed number to this all this. It's basically a lot of this is based on probabilistic thinking. Assign a basically you come up with a range of probabilities of estimated value, and then
mm,
once the risk reward is in your favor, you make the investment.
correct. And you mentioned I think 5 to 6 sectors where you are bullish. As a retail investor, how I can go and approach and figure out these sectors that might tend to do well. Is there a screener? Is there a scanner that I can run through and I can just get a list of companies which I should be reading? How do you go
The
about
most
that?
simple thing is just go on Google Gemini. They just you just ask Google Gemini for list of names, listed names in each of these industries. It will throw you up a list of names. Then you go to free
Okay.
screening tools like Tejori Finance or
Winner.
screener.in. Then you can
Mm-hmm.
start, getting a basic summary of the past financials and past track record of these companies. But that is just the initial initial headline level analysis. When you are a serious investor or a fund manager, you have to go deep into each name. In terms of, when I say deep into each name, what am I referring to? You have to go through the a conference call transcript of at least the last 4 to 8 quarters. You have to go through the annual reports of at least the last 3 to 5 years. You have to go through the press releases and investor presentations of at least the last 1 year. You also have to go through management interviews of the companies that you're tracking or studying, both in print and digital media. In addition to that, you also have to go through the same list of resources for all the listed competitors of the business that you're investing in,
Correct.
because that
Right.
again will give you, because if you're, if you're suppose wanting to invest in this particular business, the management of that company may paint an overly optimistic picture, but you want to corroborate what the management is saying with what its global competitors and local competition in India is saying. So you also go through the competitors, conference calls and commentary as well. So there's a lot of work which goes into selecting a single company for investment.
That is why I think that entire narration that retailers should depend on uh, fund advisors for their fund management is pretty serious, because doing all these things is practically impossible for somebody who's already doing his work or her work and then also doing this on the side. So somebody like you or somebody like a mutual fund manager comes in the picture where they can manage that fund in a proper way.
Agree. Because you
Um,
see, if you want good legal advice, you want to hire a good lawyer. If you want good medical
correct,
advice or good treatment, you want to go to a good doctor. Similarly, if you want to
correct.
give your hard-earned savings the respect it deserves, you should look for a good,
For
experienced investor or fund manager.
correct. Gautam, you mentioned about one stock where you exited after 3 months, which gave 200% returns. Is there an exit criteria that you go by that, yes, this is the expected return that I had in mind, I'd achieved it, now I'll exit, no matter uh, if there's some still fuel left in the stock or there's some still potential left in the stock?
Irrespective of the market cap of the company, the exit criteria is very simple. Either the stock has reached an absurd level of valuation which cannot be justified by cash flows even 5 years out. That's an easy exit trigger.
Mm,
Second is gross capital misallocation by the management. If the management of a high return on in capital company business starts deploying all the new free cash flow into value destructive, low return on investment projects, then,
mm,
because investing is all about the future trajectory of the return ratios, the market will start derating that particular business if the management basically engages in gross capital misallocation. That's also an exit
correct.
criteria. If the company engages in any serious corporate governance issues or short changing
Mm,
quality shareholders, that's also one more exit criteria. And finally, if you have a much more superior investment available in the market, when I say much more superior,
opportunity.
or in terms of potential returns in the future, if it's
Mm.
offering much more superior return prospects, then that's also an exit trigger.
Do you tend to track stocks once you exit them?
Yes, I no, I basically don't track them actively like that, but if there's an industry tailwind, then this stock will definitely fall into one. No, I will come into my radar because of my daily screens which I use. I'm sure it will come into my radar again in the future. I do not dismiss any stock in which I made an investment in the past. I look at it with a fresh lens, because if you,
Even if
yeah.
even if that stock has given negative returns to you in the past, you still look at with a fresh lens
Yeah,
going
again, like I
forward.
mentioned, right? Past is irrelevant here. In investing,
Right,
basically the moment you sell a stock, you forget about it. Similarly, the moment you buy a
right,
stock, you forget the price you paid for it. It becomes irrelevant. The cost price is irrelevant for you. So, you
correct.
basically, if you start thinking that, okay, this stock gave me negative returns in the past, you will end up having negative bias against that particular
Mm,
and in that particular stock. That's, in investing, there's no place for bias. You want to look at everything with a fresh, objective lens. Where you're standing right
correct.
now, and where does the, for example, I'll just explain this with the help of Sterling Technologies itself. This is a company in which I've lost money in a personal capacity in the past, because there was a glut in optic fiber capacity because of China in the past.
Yes.
It was in 1890. The stock of Sterling Technology simply crashed that time. But if I had that bias against the quality of the promoter or the quality of the business from the past, then I would have never been able to participate in this particular stock in my fund. Again, it was a very highly risky bet, So that's why I just invested in this stock with only a 3% allocation. I do not, go
Right.
more than that for the very high risk bets in my fund. So basically, so the problem with such companies is that you cannot really bet big because of the promoter quality or the past cyclical issues in the business, because of a bad experience in that particular business in the past. You do not develop the conviction
Hmm.
to really bet big on such businesses. But if they go up so sharply in the middle of a sectoral bull market, like in this case in the last few months, then you should also have a disciplined exit system in place.
Makes a lot of sense. When you talk about promoter quality, any parameters based on which you judge the promoter quality or how the promoter is.
Oh yeah, basically at Complete Circles, Level PMS and Level Partners India Fund, we have a very comprehensive corporate governance checklist for any business that we invest in. For example, we
Hmm.
look at you know the auditor qualities, but it's very very important. What is
Hmm.
the rate of change in auditors in the company? Is the auditor fees growing faster than revenue growth in the company? Are there any qualified opinions given by the auditor on the reporting of the company? You also want to check
Hmm.
whether the company has shared wealth with shareholders in the past through dividends and or share buybacks. You also want to check whether there has been any excessive dilution of equity by the company in the past, or any pledging of shares by the promoter.
Hmm.
You also want to see how working capital intensive the business is. You also want to check the
Hmm.
trends in the past conversion of reported profits into cash flow. For example, you check the EBITDA to operating cash, the operating cash flow to EBITDA ratio, and the operating cash flow to net income ratio. You also want to check for trends in the debt to equity ratio. Check for any contingent liabilities in the books of the company. Check whether there have been any statutory defaults in the past. For example, as the if the employees are eligible for provident funds, APF, then has the company made that necessary contribution as well in the past or defaulted on that. Check for any off balance sheet obligations. For example, has the company guaranteed the debt of its other group companies through the listed entity. And there's a host of various other metrics that we track. Is the company building lavish corporate offices using minority shareholder money? That's also bad use of capital. Is the promoter of the listed entity running a similar business in his privately held company in which he owns a 100% stake?
Oh,
Because that may lead to a conflict of interest. Check for the accounting quality of the company. Is the revenue recognition policy very aggressive, overly aggressive? Is the company capitalizing routine operating expenses to smoothen out earnings and to inflate earnings? Host of things that we look for when we invest in any business.
got it. And what about some of like once you do this due diligence and once you do your corporate governance check, do you tend to over-allocate in companies where you see, the corporate governance is awesome and you can go maybe double-digit allocation in that? Does that happen?
So I size new positions in my fund and the PMS at between 3 to 5%, 3 to 5% at cost, and then subsequently I average upwards if the management executes above my expectations. So we basically like to let the portfolio concentrate on itself organically instead of going all in at the very
Okay.
beginning. Experience in the
Mm-hmm.
markets have taught us that the unknown and the unforeseen or the unexpected keeps on occurring with much more regular frequency than we expect them to happen. So that has made us much more humble in terms of position sizing, and that's why at all points of time in Complete Circles, Level PMS, and in Level Partners India Fund, we hold a portfolio of between 20 to 25 stocks at any point of time, diversified across industries and risk factors to avoid single factor risk.
Got it. And Gautam, one more thing that I've seen in small caps, like while I was working in small caps, and I still track the small caps very actively. A lot of businesses, start growing in terms of share prices given once they start receiving orders. So their order book inflates, but it takes a lot longer for that order book to translate into revenue. So how do you see that? Do you have a number in mind? Ki yes, this much of order book should get translated in this much of revenue in so much of time, or how does that work?
So the latter part of the question is very easy to answer. So the management themselves will tell you and the conference call how long it will take for the new orders to convert into realized revenues. But more importantly, how does one value such companies? Or how, because you cannot really do a DCF in case of such companies, because They're order driven businesses, project driven businesses. DCF is basically
Right.
meaningless for such kind of businesses. The
Mm,
tip to invest in such kind of businesses is to basically buy them when they are undergoing a stage of expanding order book. So, as long as the order book is expanding, you'll see, and so that is when you'll enjoy the fastest pace of stock price appreciation. The moment order book growth starts decelerating or declining or fall, or the pace of growth or pace of increase starts decelerating or falling, you take a dispassionate exit. Basically, you want to remain invested as long as the order book is expanding, and exit at the first sign of order book growth tapering off. That's basically how you invest in such businesses.
all right. And one last question, Gautam. I would like to know how you tend to keep your belief stronger during times like 2024 to 2026, or maybe a 2018 to 2020. Since you invest into small caps, I'm only talking about small cap cycles. How do you tend to have a firm belief that, this will generate good returns and it will also outpace the currency drawdown that happens at regular intervals of around 4 to 5 years? How do you keep that belief while investing?
That's again a very good question, Kunal. And again, this answer will be very, very straightforward here. Have a unwavering faith and conviction in India's business ecosystem and the capacity and caliber of its promoters and business people and entrepreneurs. That is basically the single belief that will help you stay the course during bear markets and across market cycles. Because if you do not have this faith, like look at any big investor on Dalal Street, any big famous investor or legend on Dalal Street, all of them have just one single factor in common, this very faith and conviction in India as a country, that whatever may happen periodically, India as a country will do pretty well over the long run and will keep on growing. This is at times like these, and during bear markets we really miss the great late Mr. Rakesh Jhunjhunwala. He always used to talk about how he expects the mother of all bull runs to occur in the Indian markets, and even in the depths of pessimism, he always used to sound so bullish, and he was so bullish on the prospects of the country. When valuations used to be expensive, he used to flag them as well, that the markets have become expensive, they may undergo a sharp correction, but that did not detract from his belief in the long-term
Indian
potential of the
markets.
country as a whole. So I think that is the approach basically which you have to take. This top down we will greatly help you, stay the course on bottom up stock opportunities all throughout your investing journey.
Makes sense. Uh, I think it was lovely having this discussion with you, Gautam, because your all points were too much to the point, and you were, right there with all the answers, and you had all the examples also ready with you, with no matter whatever question was thrown at you. So I was very glad to conduct this podcast with you, and hoping that someday, if I would be traveling to the US or you would be traveling to India, we'd be doing this offline as well, where we'll get to interact more and maybe have a longer discussion around Indian markets. So thank you so much, Gautam.
Sure, Kunal. Thank you for your time.